Now, these three companies can either skyrocket or come crashing down in the upcoming earnings season, and there are a number of key factors why. I'm going to be talking about the company's valuation, some of the things that have affected their business in the last couple of months. Now, one of these companies could be up to 30% undervalued. Another company basically, suffered a huge setback to their businesses. However, customers seem to be pretty forgiving and the fallout isn't as bad as expected. And the final company that we are covering have been in the headlines for all sorts of wrong reasons, but at the end of the day, they seem to be able to come out the other side unscathed. But as always, potential is a dangerous word, so let's dive in. Now, before diving into the details of the company, we have to understand where we find ourselves in the economy before going into this earnings season. Now, if we take a look at the S&P 500, the S&P 500 is at all-time highs, and the Nasdaq isn't too far behind, right? Having recovered from about $420 all the way up to $492 in the span of 2 months. If you take a look at the CNN Fear and Greed Index, we are on the brink of extreme greed, which is also why I think finding companies which are undervalued in the stock market isn't easy. In fact, I think that there are some, pretty undervalued opportunities outside of the US markets, and I may cover that in another video. However, in this video, we're primarily talking about the US markets. And so as we all know by now, the Federal Reserve has actually cut the interest rate, but bond yields continue to rise. And while jobs data in a sense have come in pretty good on the surface, we all know, jobs data tend to be backwards looking and it's pretty prone to revision. So we don't actually know how the revisions are going to be until the time comes. Now, recession fears haven't fully subsided, and I think we can get a clearer picture on how the economy is really doing in this upcoming earnings season, and that will give us a better idea of how to position our portfolio moving forward. But I guess, if you take a look at the stock market isn't really pricing in a recession. And so if one does hit, like the US really goes into a recession, or if we get a poor earnings season, which actually sparks fears of a recession, then we could really be in trouble. But as we go through these companies, I want to remind you that this isn't a buy and sell recommendation. I think the valuation models that we use are only as good as the assumptions that we put in. And it's not enough to say, because I'm using a small growth percentage, so I'm being conservative, unless you really understand how these assumptions were derived. So this is just a broad overview going into the earnings season. Now, I just want to say, actually going into these upcoming earnings seasons, right, one of my favorite risk to reward play is actually SoFi. It has been lagging the markets and it's pretty undervalued, in my valuation models. And I think, in fact, when fintechs all around it have been going up in the recent weeks, right, SoFi seems to be stuck in the $6 to $8 range. And actually, I actually scripted this video quite a while back. So at time of filming, it's not stuck in the $6 to $8 range anymore. In fact, it's up over 10% today, flirting with $10 for the first time in a long while. So I'm really interested to see how they perform as they achieve their fourth quarter of GAAP profitability. But I'm not going to be talking about them here because I actually made many videos on my valuation models and things like that for SoFi, which I'll link down below for you to watch. And I'll do a more SoFi specific earnings video closer to their actual earnings date. But the first company I want to talk about is a fintech that we all know, PayPal. When you take a look at PayPal stock, it is up 31% year to date, but it hasn't always been that way. It was range bound for most of the year, trading in the 60s. Just in the past month, they actually rolled out PayPal Fastlane, which enables a faster guest checkout. And to be honest, before looking into the payment space, I never ever thought of guest checkout as a market itself to serve in the payments industry. So when they explain, how many people don't actually want to do the guest checkout and give their credit card details to the company, it was actually a problem that resonated with me. I think the best way to explain it is, I always found it a problem, but I kind of just accepted that this were how things were. And at every checkout, I basically end up having to weigh, whether or not I actually want to give my information to the company and whether or not I really want the item. So by using Fastlane, I think PayPal kind of lowers the friction to buy for the company, and they actually increase conversion by 80%, increase the checkout speeds by 32%, and all of this in August. In August, right, not just did they launch Fastlane, they actually also expanded their partnerships with different companies like Adyen, who also offers Fastlane in the US. They also work with Shopify to power a portion of Shopify's payments and expanded their partnership with Fiserv to streamline checkout in the US itself. In September, PayPal also enabled businesses to buy, hold, and sell crypto. And with their pace of execution and innovation, I think it makes these upcoming earnings interesting to see actually what management is going to guide for in the final quarter of the year and perhaps to see whether or not they actually give us any guidance for 2025. And I think we all know by now, Alex Chris has said it a couple of times before that 2024 is a transitional year for PayPal. And as they exit this transitional year, I think it's interesting to see how they're going to perform in the year going forward in 2025. And we can have a better sensing of what kind of company they are growing into. Now, historically, PayPal tends to trade closer to 30 times PE. And I think while many people may argue that it's actually a slowing company, it shouldn't be trading at such high valuations, right? I think there's some truth in that in the past. However, the slowing growth was actually down to previous management, and totally discounting it or saying that it doesn't deserve a higher multiple really just discounts the work that Alex Chris has done so far. So if you ask me, I don't really think it should be trading at what people consider to be fair value in the markets, around 15 to 20 times PE. I think with what Alex Chris is doing with the company, he deserves a little bit of premium, and to be trading at 25, maybe even 30 times PE, like what he has done historically, isn't too far-fetched, especially if they can deliver on what they promise, and which is why this upcoming earnings is important. Overall, the key metrics for this company has inflected upwards. The total active accounts are actually going up, and the company attributed this to lowering churn compared to 2023, which basically shows that, they have managed to retain customers and plug the outflows. Payments per active account were also up 11% year over year. So I also just want to say, in Singapore, right, actually we don't really use PayPal, but even then, right, I've started to notice PayPal popping up more and more frequently as a payment option when I'm online and things like that. So because of that, I've started to use PayPal more and more as my payment option. The operating income growth, not just the operating income, but the growth of the operating income year over year is also accelerating after bottoming out at around 2% back in September of 2023. And operating margins are inflecting back up to around 18% after a low of 11.5% back in March of 2022. Now, all this at the same time, PayPal is also buying back shares. They are buying back a total of $6 billion worth of shares in 2024. They basically, if they do that, they actually lower the float by about 7 to 10%, depending on when they actually conduct their share buybacks and at what prices. So what I'm actually looking for going forward is for revenue growth to be between 7 to 8%, cash flow from operations to continue inflecting upwards, probably steadying out around the low to mid 20% range with a 10% discount rate. If you take a look over here, the implied price will be around $106, which makes it about 32% undervalued today. So if you think that PayPal can achieve these growth factors, then it is 32% undervalued. And if you consider that, it takes about 3 years to achieve this, then that's a 9.9%, call it 10% CAGR moving forward. And so this is something I'm definitely looking at going into earnings. I think for me, the most important factor is the cash flow margins. You can see over here, if they can actually maintain this around the 20% range or even slightly more than that, then it's definitely an undervalued company. Second company I actually want to talk about is CrowdStrike. Usually when I invest, I like to invest in B2C businesses. However, CrowdStrike really caught my attention. I mean, the whole world literally stopped because of them, so it's hard for them not to catch my attention. And despite all of that, right, the stock is still up 25% year to date. Now, I honestly thought that the blowback from the worldwide blue screen of death or the tech outage on 19th of July would have hit them a little bit more than it did. And I think that combined with the yen carry trade basically saw the stock fell all the way from a high of $398 all the way down to $200. So I guess, hindsight is 2020, and a lot of people say, I should have bought the CrowdStrike at $200. But I just want to remind us, not to feel bad about it, because at $200, people were actually worried that customers would eventually leave CrowdStrike because of the reputational harm it has done to itself. And I think there wasn't any clarity at that point in time on how this would actually impact their top and bottom line, because the compensation they probably had to pay because of all this tech outage will definitely eat into the margins. And, like the concerns that I was mentioning earlier, people don't really know how the loss of customers is going to impact them moving forward. Now, I've always thought that, the cybersecurity space was actually an important one, but I never really gave CrowdStrike much of a look in because of their high valuation. And I think what changed was really seeing how big an impact CrowdStrike has on the real world and how actually integrated it is into part of our lives without us really realizing it. And as you know, I really do like a company with a big TAM. And when, governments stop working, flights are grounded, hospitals go haywire because of you, well, I guess it's safe to say that you have a pretty big total addressable market. And so if you take a look at it from a business perspective, then I want to say that, mistakes really do happen. And what I'm actually looking for is management's recovery and how they handle this situation. When I take a look at their recent earnings, they actually estimate their TAM to be about $100 billion in 2024, and for the TAM to actually more than double over the next couple of years to $225 billion. So you can see that CrowdStrike is only just getting started. Now, for those of you who are not aware, CrowdStrike was actually founded back in 2011 by George Kurtz. And for those of you old enough to remember, George Kurtz was actually the CTO of McAfee. If you have no idea what I was just talking about right then, well, you should be thankful you're pretty young, right? And the main offering is basically the Falcon platform, which is the first cloud-native cybersecurity software that can offer protection not just on-prem, but also in the virtual and cloud environments. And they don't just actually protect devices and all that from threats, but their AI models are trained to, actually learn and study and identify threats even before it happens. So, all their updates that they do is actually pretty seamless, can be done through the cloud, which is always a selling point for them until, they cause another worldwide outage, okay? Well, if you ask me, I actually do struggle to say that I find CrowdStrike as an undervalued company. I think the question facing us is not whether or not this is undervalued or overvalued, is whether we actually think CrowdStrike deserves to be trading at the premium it is trading at today. Now, when companies trade at a premium, right, I think one of the very important things that we need to assess is the moat of the company. And for me, when I take a look at CrowdStrike and this whole debacle of the blue screen of death, I think I expected a bigger exodus of clients, but it didn't seem to be the case. So this could definitely be a sign that their product is so good, it's so sticky. They actually built up a lot of goodwill with the clients over the years, and it made it such that even with such a big mess up, with such a big boo-boo, I think clients still choose to continue working with them. So I guess that can be said, is a testament to their moat. So for sure, it seems like they have a sticky product with probably high switching costs as well, and that could be a reason why people are okay to pay a premium for owning this company. If you take a look at CrowdStrike's most recent earnings results, even after the outages, you can actually see that their revenue growth year over year was maintained, and actually what dropped was their net new annual recurring revenue. So what this means is that there seems to be a slowdown in new clients being onboarded onto their platform. This could be one of two reasons. Of course, it could be because new clients are just basically hesitant to be onboarded onto their platform after seeing what just happened, and this is something that we need to pay attention to. Or it could just be because CrowdStrike are busy servicing their existing clients, conducting service recovery, so they don't really have time to actually focus on signing new clients at this point in time. So this is something that at least for now doesn't seem to be affecting revenue growth, but we really have to keep an eye on this moving forward. So, whether or not clients are not leaving their platform because they actually like the company, or whether or not there's some sort of contractual agreements that prevents clients from leaving their platform, really still isn't clear, at least to me. Analysts, they actually say that they don't see any significant near-term churn because customers are not jumping ship. But like I said, this remains to be seen. Is it because of a contractual obligation, or is it because they really, really like their platform and really, really like the service that CrowdStrike is offering to them? So this is something we're going to pay attention to moving forward. Now, if you take a look at the historical price to sales ratio, it seems like on the surface, right, it's pretty fairly priced right now, because at about $320, it's actually trading at 22 times price to sales. However, if you ask me, you look at it objectively, right, 22 times price to sale is a rich valuation, and so for a company to be trading at such a rich valuation, they must really be doing something that sets them apart from their competitors to deserve this multiple. Because if you take a look, at the industry with similar competitors, comparatively, right, CrowdStrike is 46% more expensive than Palo Alto and twice as expensive as Fortinet. So of course, I think I said previously in my other videos that valuation is basically a function of sentiment, which is the multiple, as well as the execution of the company. And I guess in CrowdStrike's case, the execution has been pretty good because their revenue is currently growing at about 32% year over year compared to Palo Alto Network, which is basically growing at 16%, and Fortinet growing at 11%. So I think we can see that CrowdStrike is trading at a premium, or people are willing to pay a premium for CrowdStrike because of its abilities to grow revenue compared to its peers. So I think this makes the impact of the global IT outage even more important, because if there's a slowdown in revenue because they are unable to onboard new customers because of the reputational harm done during the global IT outage, then that could be a drag on the stock price. So if you take a look at the revenue growth for CrowdStrike so far, definitely it's been impressive. They actually grew their revenue by nearly 30 times, all the way from $120 million in 2018 all the way to $3 billion in 2024. And during this time, I think gross margins actually inflected upwards, growing from 54% to 75%. So you can see why actually people are paying a premium for this company. Whether or not it deserves that premium for this kind of results is really an individual decision. So I guess their revenue stream is actually also pretty robust, because if you take a look, 94% of their revenue actually comes from subscriptions and 6% comes from professional services. And this is when they actually send their engineers down to the companies to actually help out and things like that. On top of all of this, their subscribers actually grew from 23,000 back in 2023 to 29,000 as of January of 2024, and they don't really have customer concentration because there's not one customer that accounts for more than 10% of revenue. So that's very good. So that means even if they lose one customer, their revenue will not be hit as much. So I'm interested to see eventually how this July outage really affects them moving forward. And if you take a look at guidance, right, they actually lowered their guidance in terms of revenue and profitability all around, with operating income falling from 900 million to about 780 million, and EPS from about $4.03 to $3.65. So I guess moving forward, I think we are interested, or we need to pay attention to whether or not there are any further downward revisions in terms of revenue and profitability, and for management's guidance for growth going forward, because the lower annual recurring revenue basically is an indication to how fast and whether or not how many new clients they can onboard, and we want to see this continue to inflect upwards after these few quarters. I think if they can maintain the same pace of revenue growth and profitability, and you can see all these numbers start to inflect upwards, I think that will speak to their moat, that even after such a blunder, people have no choice but to use your product, or they actually really like you enough such that they forgive this blunder, and this is not because of some sort of contractual obligation such that they have no choice and they're just stuck with you. The last thing for me that I just want to point out is that when you actually take a look at their net income numbers, right, a large part of their net income actually came from their interest income, and I want to see a transition away from that and have a larger portion of their net income flow down directly from operating their business rather than the interest that they actually generate. So I'm not going to use a discounted cash flow here because, like I said, they are a company that actually recently just turned profitable. A lot of their income is actually coming from interest income, so there's no real use of the DCF at this point in time, and because they're not optimizing for profitability at the moment, so I don't think this is going to be as helpful. So for CrowdStrike, the way I look at their valuation generally is the historical PE and the historical price to sales ratio. I don't really use DCF here because I think at this point of their business cycle, they basically just turned profitable recently, and with a large portion of their income actually coming from interest, I think the results really require too many assumptions. So I think what we need to wait for their business to actually reach a steady state where their revenues, their profitability is a bit more stable before we can actually run a DCF on this company. So all in all, for me, I think CrowdStrike is basically priced for perfection, slightly on the richer side of the valuation. And it feels like, one of these companies where even one decimal off in their earnings numbers, right, can actually cause a large sell-off in the stock. And if so, I'll really be paying attention in the upcoming earnings to better understand their forecast going forward before deciding if I really, really want to open a position. And if I do open a position, I'll definitely make a video about it. Now, our third company basically needs no introduction. The fact that you are here watching this video, you're on the platform that generates this company 10% of its revenue. Yes, we are talking about Google. Now, by the way, Google just increased their YouTube premium subscription prices in Singapore starting from November. So I guess it looks like YouTube numbers will be going up in the next quarter, right? So Google stock, I think despite a recent fall in price, is still up 18% year to date, which is not too bad. But if you consider that the SPY is up about 22% year to date, there is a slight underperformance here. So the question is, why is it underperforming, and why, am I looking at this company going into earnings? Now, if you want to know why Google is undervalued and why it is actually currently underperforming, right, it can be summed up in one word: fear. Now, there are basically, I guess, two things that investors are afraid of right now that basically is a drag onto the share price. I think the first being the anti-monopoly lawsuit. Basically, Google just lost their antitrust case over search. I think the judge found them guilty of being a monopoly. I think whether or not it is the case, whether or not the appeal actually goes through still remains to be seen. And I think it's one of those things that keep happening over time that I think some investors are already used to it, and it's just part and parcel of investing in all these big tech companies. And I think one of the issues that were brought up is how Google is actually paying Apple to remain as the default search engine on their iOS devices. And so they basically threatened to break up the company. And I think the fears here are a little bit overblown because of a couple of reasons. Now, I think I heard some people say in the news, right, that breaking up Google may not be a good thing for the consumer because certain business segments, if they operate on their own, right, may be forced to charge higher prices. So that really remains to be seen, and I think that's not the focus of this video. I guess what we're looking at is, as an investor, what is going to be the implications for us if they do break Google up. Now, I think it may not be as scary as people think because let's consider how their business is structured. Right, so one big part of their business, like I mentioned earlier, was YouTube. And if we consider YouTube on its own, right, YouTube is a segment of their business that generates about $35 billion in revenue, and it's growing at 13% year over year. So if you think about it, this is actually comparable to Netflix. Netflix also has a revenue of about $36 billion, and they're growing at 13% year over year. And right now they are trading for 8 times price to sales. And so if you apply that to YouTube, that would actually say that YouTube itself, by itself, is a $280 billion company. Now, if you consider another part of their business, Google Cloud is basically their fastest growing aspect of their business. Currently, it's generating about $41 billion in revenue with a 10% operating margin, growing at 28% year over year. Now, if you take a look at Oracle as a reference point, Oracle's revenue is higher at $53 billion, but their growth is only at around 5%. And even so, they are basically trading at a 9 times price to sales ratio. If you use another company like Broadcom with $46 billion in revenue, gross margins in the 70% range, growing at 31%, then they're trading around 17 times price to sales. So even if you take the midpoint of about 13 to 14 times price to sales, right, that will put you at about a 550 to 570 billion market cap for Google Cloud. So after you consider the valuations for YouTube for Google Cloud, I think you can net off their cash position, which is about $100 billion, and some of their other bets, right? You basically end up with their Google search business, which is generating about $194 billion in revenue, growing at 13% year over year. Now, for context, right, Microsoft's whole business only does about $245 billion in revenue, so Google search is actually not too far away just by itself. And Microsoft is growing at 15% compared to Google search 13%, and so this is a fairly comparable companies, and Microsoft is basically trading at 12 times price to sales. So at current valuation, right, the Google search business is only valued at somewhere close to 5 times price to sales, which means it is undervalued, and if they do break Google up, there is actually shareholder value to be unlocked over here. So if you ask me, I think the breaking up of Google isn't something that investors should be too concerned about. Now, if we're going to talk about another headline that actually got investors a little bit spooked, is basically this Wall Street Journal article that came out that talked about Google potentially losing its dominance in search. Now, if you just take a look at the numbers with me, right, Google's search revenue basically came in at $162 billion back in 2022 and $175 billion in 2023. And right now, in 2024, they are on pace to generate about $194 billion in search revenue. So this is basically a 13% growth year over year. And if you compare it to the entire search market, the entire search market is growing at a CAGR of about 11% all the way through to 2031. So because of that, if you take a look at the numbers, right, you can actually see that Google is basically maintaining their market share. And this whole Wall Street Journal article that talks about Google potentially losing their market share is basically a narrative around Google that, comes out every now and then. But if you take a look at the actual numbers, it's not really showing it yet, and I trust the numbers more than some narrative that comes out in the article in the Wall Street Journal. So moving forward for Google, what am I actually expecting? I think I'm expecting to see cloud growth continue to be strong, coming in at 28%. Last quarter was actually quite good. Hopefully they can break the 30% mark, and as well I want to see increasing or expanding margins for their cloud. So at the moment they're operating at about a 10% profit margin or 10% operating margin. However, I think AWS basically set the standard with operating margins of over 35%, and I want to see Google trend towards that kind of numbers as well. And if they do, we can kind of expect a similar multiple applied to them. So previously, I think I did a DCF using my own assumptions, and I used both, the perpetual approach as well as the terminal multiple approach, which basically, ended up with $190 over dollars average. But if you just take a look at this more simplified DCF, and I basically use more conservative revenue estimates based on what the analysts actually do, you can see that the price target basically lowers slightly to about $178 fair value. With a 10 to 20% margin of safety, it makes it relatively safe entry point between $144 to $162, which is where I did most of my buying. However, there are 3 other companies that really have a chance to move on earnings, and they're really, really undervalued at this point in time. And I talk more about them in this video over here, and I'll see you in the next one.